Most investors are still licking their wounds from Q1. But while fear's in the air, a quiet group of safe dividend-paying giants is delivering surprising returns. I found 7 safe stocks still surging. And stock number 3? It's raised dividends for 47 straight years. Let's dive in. First up, a name you definitely know, AT&T, ticker T. With a market cap hovering around $195 billion and a forward dividend yield of about 4.2%, AT&T is more than just a telecom giant. It's a quiet powerhouse with deep roots that go all the way back to 1885. After a massive restructuring in 2022, AT&T slimmed down, shed some debt, and became more focused. It wasn't an easy transition. Profits and dividend payouts took a hit initially, but the payoff has been impressive. In the past year alone, AT&T stock has jumped over 50%, significantly outperforming the broader S&P 500. Why the surge? Because now, it's leaner, more focused, and still has one of the largest wireless networks in the country, with roughly 120 million subscribers. That's a lot of recurring revenue. The upside? It's a stable, dividend-paying stock with a defensible business. The downside? Growth potential may be limited in a saturated telecom market. But if you're looking for steady income, AT&T is hard to ignore. But before we go any further, here's a quick one for you. Is the market giving us a comeback story? Or just teasing us before the next plot twist? Drop your hot take in the comments. Stock number 2, Coca-Cola, ticker KO. This isn't just a soft drink company. With a market value of $304 billion and a 2.9% dividend yield, Coca-Cola is a global beverage empire. Sure, Coke is known for its sugary sodas, but its reach is far wider, from bottled water and seltzers to juices, teas, and sports drinks. And when the economy gets choppy, consumer staples like Coca-Cola tend to hold their ground. After all, people don't stop drinking beverages in a downturn. Coca-Cola operates in over 200 countries and has been around for more than 130 years. It's one of the most iconic brands on earth. And get this, it has increased its dividend for over 60 straight years. Talk about consistency. The risk? Health-conscious trends and sugar taxes can put pressure on soda sales. But Coca-Cola's ability to innovate and diversify its product line makes it a strong contender for any long-term portfolio. Next, a stock that might not be flashy, but is built like a fortress. Stock number 3, Consolidated Edison, ticker ED. With a market value of around $36 billion and a forward dividend yield of 3.4%, Con Ed is one of the most established utility providers in the U.S., serving millions in the densely populated New York City metro area. Utilities like Con Ed operate in a unique space. They're highly regulated, often monopolistic in their region, and benefit from predictable demand. People need power, no matter what's happening in the markets. Con Ed has increased its dividend for 46 straight years, making it a go-to pick for income-focused investors who value reliability. Now, it's not a growth stock, but if you want slow and steady, this is it. Here's a name you may not expect on a safe stock list. Stock number 4, Dollar General, ticker DG. With a $20 billion market cap and a 2.7% dividend yield, Dollar General is one of the largest discount retailers in the U.S., operating more than 20,000 stores, mostly in rural and suburban locations that major chains often overlook. Here's what's interesting. When the economy weakens, Dollar General tends to get stronger. Why? Because more people look to stretch their budgets, and that leads them straight to DG's low-cost offerings. The company has been riding that trend this year, with shares climbing over 20% since January, and with a growing dividend to boot, it's proving to be a counter-cyclical gem. Of course, retail is a competitive space, and supply chain hiccups or rising wages can eat into profits. But Dollar General's niche focus and cost-conscious approach give it a durable edge. Now let's talk about real estate, but with a twist. Stock number 5, Healthpeak Properties, ticker DOC. Following a major merger with Physicians Realty Trust in early 2024, Healthpeak has emerged as one of the largest healthcare-focused REITs in the U.S., with a market cap near $12 billion and a monster 7.1% dividend yield. REITs, or real estate investment trusts, are legally required to return 90% of their taxable income to shareholders, which often means huge dividends. Healthpeak specializes in medical office buildings, senior housing, and life science properties, all sectors that benefit from aging demographics and long-term healthcare demand. The challenge? Rising interest rates can increase borrowing costs and pressure REIT valuations. But the long-term tailwinds here, especially as America's population ages, make Healthpeak a compelling income play with real staying power. Let's shift gears to a healthcare legend, Stock number 6. Johnson & Johnson, ticker J&J. With a massive $357 billion market cap and a 3.5% dividend yield, J&J is a giant in the pharmaceutical and medical device world. After spinning off its consumer health division, Johnson & Johnson is now laser-focused on its most profitable business lines: high-margin drugs and surgical technologies. It's one of just 2 companies in the US with a perfect AAA credit rating. The other is Microsoft. That means even in a financial crisis, J&J has the borrowing power and balance sheet strength to keep going. Oh, and it's raised its dividend for 63 consecutive years. Risks? Like any pharma company, J&J faces regulatory challenges, lawsuits, and drug pipeline uncertainties. But its scale, history, and brand strength make it a cornerstone stock for many portfolios. And finally, let's talk defense. Stock number 7. Lockheed Martin, ticker LMT. With a $107 billion market value and a 2.9% yield, Lockheed is a cornerstone of the U.S. defense sector. Known for cutting-edge military hardware like the F-35 stealth fighter, the Black Hawk helicopter, and more, its long-standing contracts with the U.S. government and allies worldwide give it a durable revenue stream. In fact, even in the current 2025 draft budget, the Department of Defense has been largely shielded from cuts, a sign that Lockheed's funding isn't going anywhere soon. Lockheed has doubled its dividend over the last decade, and with global tensions remaining high, defense spending isn't likely to shrink anytime soon. Now, one caveat: government contracts can be subject to political changes and budget reshuffles, but Lockheed's track record and deep relationships in Washington provide stability. So, looking at the bigger picture from the chart we just covered, what stands out? Every stock on this list, whether it's a household name like Coca-Cola or a defense titan like Lockheed Martin, brings something different to the table. We're talking about diverse sectors, strong market caps, and most importantly, reliable dividend yields that reward patience and consistency. These aren't trendy stocks chasing hype. They're built to last, backed by decades of experience and billions in market value. Think about it. You've got AT&T and Consolidated Edison offering stability through essential services, Dollar General holding up during economic downturns, and even Healthpeak Properties leveraging demographic shifts to stay relevant. And let's not forget Johnson & Johnson, with one of the most impressive dividend streaks in market history. Together, these companies form a sort of dividend all-star team, offering not just income, but a buffer against volatility when the market gets shaky. It's like having a portfolio that pays you to wait, and who doesn't love that? If you're after safer plays in uncertain times, this lineup might just be your cheat code. So, what's the big takeaway here? While no investment is 100% risk-free, these 7 companies all offer something rare in today's market: scale, reliability, and a steady stream of dividends. Whether it's telecom, beverages, utilities, discount retail, healthcare, or defense, each of these businesses has carved out a resilient niche. And in uncertain times, that's exactly what many investors are looking for. And before we wrap up, let's make this fun. If you had to ride out a market crash with just one stock, what's your ride or die pick? Let's hear it in the comments. Who knows? You might inspire someone's next big move. And if you're looking for the next NVIDIA, check out these 10 best semiconductor stocks for 2025. Click on this video here.